Hello and welcome to the latest edition of Easy Money. My name is T.M.Hoy, founder and editor of smallbusinessfinancingonline.com, and this is my lovely co-host Caroline Lisiak, winner of the Hottest Businesswoman of 2013 contest. Today we're going to be discussing crowdfunding and peer-to-peer lending, the second in the series on the subject. This is a general overview of crowdfunding and will give you enough information to use peer-to-peer lending to finance your business. Now, for most businesses, banks do a lousy job of providing the capital they need. More businesses borrowed from their suppliers last year, $2.15 trillion as a matter of fact, compared to $1.5 trillion borrowed from banks. Considering that suppliers aren't really lenders, this is a shocking number. The idea that the average business gets more credit from suppliers than lenders shows the system is badly out of whack. Another example is that out of the 27.5 million companies doing business in the United States last year, venture capitalists funded only 3,800 of them, less than 0.2%. Huge numbers of companies obviously are doing without the financing they need. In consequence, business people have to get creative, and a big part of that creativity is the new field in finance of crowdfunding. There are different names for crowdfunding: crowdfinancing, equity crowdfunding, peer-to-peer lending, but whatever you call it, it's about individuals pooling their funds together on the internet to support the efforts of others. There are actually three separate kinds of lending going on here. The kind that we discussed in the last video was rewards-based crowdfunding, which is the kind you use with Kickstarter and Indiegogo. There's also charity-based crowdfunding, which we'll discuss in a moment. Peer-to-peer lending, on the other hand, puts borrowers in contact with individual lenders, whereas the other types of crowdfunding tend to keep lenders at arm's length from borrowers, and in general are for smaller amounts. Charity-based crowdfunding is pretty simple. There are crowdfunding platforms or websites that connect people supporting different types of activities and organizations with those doing the nonprofit work. Sites like CrowdRise, MicroPlace, and Start Some Good. The home pages of some of these charity-based crowdfunding websites are on your screen now. Let's take a look at these here real fast. Okay, and that one there we go. Okay. Okay, and right. Okay. Sorry about that. There's usually no quid pro quo for donating, just the gratitude of the nonprofits, and sometimes ego-type rewards such as acknowledgments, honorable mentions, and so on. How effective the charity is at raising funds in this way depends almost entirely on good media presentations and understanding how to create an attractive appeal on the website platform. Those interested in this type of crowdfunding are advised to visit the alternative finance section of my website or view our rewards-based crowdfunding video on YouTube or my site. In a few words, though, rewards-based crowdfunding seeks contributions in exchange for future goods and services. There's no actual repayment of funds, but rather a graduated scale of goodies that are offered to donors depending on the amount of their donation.
This can include actual products of the project, such as software, arts and crafts, movie, and so on. Or it can come in the form of creative, say, in a project like different kinds of recognition, even cameo roles, or direct contact with the project creators. The main thing is participation with donors to encourage them to make people feel like they're getting their support.
Absolutely, that's right, Caroline. All of the rewards-based crowdfunding sites like Kickstarter and Indiegogo emphasize how important it is to get your donors involved. Creating a successful rewards-based crowdfunding campaign is its own subject. Again, check out the website. The address is at the bottom of your screen for full details. For most business owners, though, rewards-based crowdfunding isn't a practical answer. Small businesses are hard to get excited about, and your local auto parts store or corner grocery aren't photogenic enough or sexy enough to gain that kind of support, nor are most small business owners media savvy. So, peer-to-peer lending. Peer-to-peer attracts investors with higher interest rates than they could get elsewhere, and at the same time, small businesses that otherwise wouldn't get funding get the capital they need. Online platforms technically fall under the rubric of crowdfunding, but they differ substantially from rewards and charity-based crowdfunding.
P2P sites invite borrowers to tell their story. Your story needs to be compelling. Tell people why you need the money, how are you going to spend it, how are you going to repay it, and all the details that are needed to give investors confidence that they're going to be repaid.
Yeah, peer-to-peer sites display borrowers' credit history, set the interest rates, and invite investors to bid. The sites usually post borrowers' loan requests, and if lenders like them, pool the cash, and forward it to the borrower. The sites also monitor the loans, collect monthly payments, distribute the funds to the lenders, and in general do all the dirty work. Peer-to-peer loans typically are unsecured, have repayment plans that are usually 60 months or less, and are fairly simple and fast. They require little in the way of documentation, for example, and are usually for small amounts, $25,000 or less on average. The peer-to-peer sites make money through origination fees, around 2 to 5% of the loan amount, depending on the credit risk, and this may be included in the interest rate borrowers pay. For example, an extra 0.25% might be added to the rate. The sites also charge for failed or rejected payments, being paid by check, and so on.
There are two giants in this business, Lending Club and Prosper. Here are their home pages on your screen right now. Lending Club has more than $2 billion in loans, while Prosper is a distant second with $500 million in loans.
Yeah, Lending Club has created a secondary market in loans called Folio FN. This makes it much easier for a lender to create a portfolio of loans and also provides a way for lenders to sell their loans should they decide to exit the investment early. There are three classes of credit risk with Lending Club. There's Class A, which is 5.7%, B, 8.87%, and C, 10.22%. By comparison, Prosper offers better returns but riskier loans. Prosper's rates vary between 6.73% and 35.36%. These interest rates vary quite a bit. By the way, take them as an average, not as written in stone. Both sites have large memberships with over 1 million members each, and Lending Club requires a minimum credit score of 660 from borrowers, whereas Prosper requires a minimum credit score of 640. Lending Club will lend up to $35,000, while Prosper lends from $2,000 to $35,000.
There are many other P2P sites, like slowmolend.com, which you can see on their homepage right here, which loans from $100 to $100 million. It has a standard operating procedure of creating a profile, having borrowers fill out a loan application, and then allows borrowers to review loan offers while giving lenders a chance to see various opportunities, decide what to invest in, and so on. Another popular site is ondeck.com. Here's a screenshot of their homepage right here. Lending from $5,000 to $25,000. Decisions on loans are made in minutes and cash is made available in a day, while loans under $25,000 can be made in under an hour. OnDeck is more flexible than most lenders. They look at your cash flow and your business performances, not just your credit. It's interesting to hear what some of the site founders think about their borrowers can get money they need. Here are founders of Cabbage talking about the early days of their company.
I'll accept that. I think that's. I'm concerned about these emails. I've expressed that to you.
Our obligation to continue to innovate in the years to come. Thanks.
Thank you.
Okay, sorry about that. We had a little technical difficulty. Okay. Okay. Cabbage.com is a site which promises loans to small and medium-sized enterprises within 7 minutes. Cabbage has a loan facility of $75 million. A few other sites include EnduranceLendingNetwork.com, which loans from $10,000 to $500,000 within 14 days, and Seed Invest, 99funding.com, Biz2Credit.com, EasyPay.com, Zopa.com in the UK. There's a long list of these sites. And the latest site, Dealstruck.com, offering from anywhere from $100,000 up to $1 million at rates between 5 to 15%. There's variations on this theme, such as sites that formalize loans from family and friends. LendingKarma.com is one, based in San Francisco, and it's been approved by the Better Business Bureau. Wikiloan.com, here's a picture of their website. And it also offers tools and templates for loans between $500 to $2,500 between family and friends. VirginMoney.com offers the same thing. And there are also sites specializing in student loans, such as Vitana.com, giving microloans to students, PeopleCapital.com, matching up students with lenders, and United Prosperity, which is an organization that makes loans with guarantees to banks in poverty-stricken areas in the third world. It's kind of similar to a charity-based crowdfunding, but it's structured as loans.
But this is the early days for crowdfunding. This kind of lending is about to explode.
Absolutely, Caroline, and a lot of it is due to the Jobs Act. Here's a picture of President Obama signing the Jobs Act. And this law, which stands for Jumpstart Our Business Startups Act, was signed by President Obama in April of last year and allows small businesses to raise money by selling stock directly to the public through crowdfunding platforms without registering with the SEC. Before this act became law, there was a ban on the sale of stock directly to the public, and the Jobs Act lifts that ban for equity-based crowdfunding. Previously, the SE registration allowed only accredited investors, meaning those earning $200,000 a year or more and with over $1 million in assets, which obviously means it's a limited portion of people that you're trying to get to invest in your business. And now you don't have to file with the SEC until 500 non-accredited investors or 2,000 total investors have been reached. A company can therefore sell up to $1 million in common stock to 1,999 people without having to go public. An incredible opportunity that will free up a lot of money for small businesses using crowdfunding. Unfortunately, there's a problem though. The SEC has not actually put the law into effect. Here's the media take on this important new law.
Ever since the Jobs Act was passed a little over a year ago, the mood amongst entrepreneurs and investors has gone from excitement and anticipation to one of frustration and bewilderment at the SEC's inability to implement vital portions of the bill, in particular Title II. Adding insult to injury, it appears that the SEC's inaction on Title II certainly is not due to the complexity of the issue itself. Indeed, it is both ironic and unfortunate that a bipartisan success, such as the Jobs Act, has been held up at the SEC for what appears to be political reasons.
This institution that has had, frankly, a pretty rough couple of years, and that you were able to get Democrats and Republicans, House members and senators to agree to the Jobs Act, and the president to sign that bill, and then to see these emails that an outside lobby group was able to prevent its implementation or a portion of its implementation is outrageous.
We've just passed the one-year anniversary of the passage of the Jobs Act and approached the one-year anniversary of the 90-day implementation deadline for Title II. Looking back during this time, we see that the SEC deployed resources to consider political contribution regulation, an area of law that the SEC has little expertise over and questionable jurisdiction. The SEC also found time to work on money market fund regulation despite no legislative mandate to do so. At the same time, the SEC failed to implement Title II of the Jobs Act, a two-page part of a highly bipartisan law with limited discretion.
You've come in and testified and said, listen, 90 days wasn't enough time for us. I'll accept that. I think that's a good point. I'm willing to accept that. I'm concerned about these emails. I've expressed that to you. But we're well beyond 90 days. We're over a year, and we're not done. I mean, are you telling this institution that a year is not enough time for you to have this issue resolved and to have a rule out?
My concern is that you've prioritized that inaction over the will of Congress and the law. We have a two-page bill. The discretion is very limited. Within 3 weeks, you had a proposed rule at the staff level. We don't want any further excuses, and I'm very hopeful that in the future we'll have some movement on this.
The SEC is dragging its feet, but full implementation of the law is scheduled in 2014.
Yeah, FINRA, the Financial Industry Regulatory Association, which is a part of the SEC, is less resistant and has helped set up self-policing organizations similar to others in the financial industry. These are setting standards for members and are in the process of creating rules and guidelines to protect investors. One of the founders of the Jobs Act, Michelle Goodman, estimates that crowdfunding will be a $4 billion industry after the SEC opens it up. Freeman White, CEO of Launched.com, runs a company that creates crowdfunding platforms for universities, nonprofits, and incubators, and believes it could be 10 times that size, meaning it could be a market of $40 to $50 billion for small business owners to tap. Here's an interview with Rory Eakin of Circle Up, a crowdfunding site on the industry and the Jobs Act.
Hello, Eric Mott for CreatorBase. I'm here with Rory Eakin. He's a co-founder at Circle Up in San Francisco. How are you?
I'm well, thank you. Good morning.
Good morning. We're actually talking about Circle Up and some of the differences and similarities too between your business model and the contribution models like Indiegogo and Kickstarter. Tell us more about Circle Up.
Sure. Circle Up is an equity-based crowdfunding site. We help small consumer products and retail companies raise growth capital. Very similar to the contribution models we've seen over the years with Kickstarter and Indiegogo, except investors on our platform receive equity in exchange for their contributions to the business. And we tend to work with companies a little bit later stage in their growth cycle. So companies raise an average of $750,000 through the Circle Up platform. They're looking to expand their products and services and exchange equity for that.
And I guess, the businesses that are pursuing early stage or seed capital, they could go the Indiegogo and Kickstarter route or similar, and then later come to you.
We see that a lot where companies will raise from friends and family or in a donation-based model, particularly the types of companies we work with in consumer products and services. There's a tangibility to the products that work well on a donation-based model for smaller contributions and on Circle Up for equity. One of the examples is a company is 18 Rabbits, which is a granola-based company based here in San Francisco. They raised $500,000 through Circle Up early this year. And while they didn't raise on a contribution model early on, they had a large round of friends and family in their early stages of growth. And I do think it lends well from the contribution model early on towards an equity-based later stages.
So they did a little more of a private crowdfunding route.
They did, that's right.
And then, in terms of the Jobs Act and what's coming up for 2013, what is interesting that's coming up around that in terms of new laws or, opportunities for entrepreneurs?
Well, the big issue will be when the rules come forward for the equity crowdfunding. The Jobs Act will be implemented, we hope, in early 2013. The rules state that it should be announced in the 1st of January of 2013, and that will open it up, the platform, to all Americans. Right now, Circle Up is limited only to accredited investors, and it would be good news for entrepreneurs to be able to tell their story to a much wider audience and have investors across the country be able to invest for equity. And we think that's a good thing for both investors and entrepreneurs.
And you've got some great resources on your site. I'll point people to your website. And thank you for your time.
Thank you very much.
I think it's safe to say that the future of crowdfunding is secure and it looks to be a fast-growing way to raise money. A few good sites that will help you keep up with crowdfunding news include crowdfundinsider.com, thenewentrepreneur.com, paymentnews.com, and P2P lendingnews.com. You can see a few of these sites' homepages here right now.
Yeah, we had a little technical difficulty there, so we're not going to be able to see those pages, but they're easy to find online if you type in crowdfunding and Google it. I really appreciate your joining us this evening, and I hope that this helps you use crowdfunding to get the money you need for your small business. Please don't forget to visit the website. Appreciate you doing that. Thank you for watching.
Bye.
Bye.